UK gas and power markets have depreciated across the curve, with the front seasonal contract shedding 40% of value since the start of October 23. These are levels last observed in winter 21, due to a looser supply and demand balance in the near term that has shifted the structure of the forward curve into a contango out to winter 25. Fluctuations in global weather patterns will remain a key driver in tandem with political risk of supply disruptions in the Red Sea that has sparked recent volatility in the wider energy market. The same price trend has also emerged in the European market, with the rate of gas price declines outstripping losses in coal prices. The TTF gas market currently trades below the average coal switching price, meaning that gas-fired power stations would financially outperform most coal-fired power stations until the end of summer. Interestingly, this lower price environment is impacting operating margins, especially in Germany, linked to strong renewables and lower demand for thermal plants. Furthermore, the lightest French nuclear maintenance schedule since January 2018 pushed French power exports to an all-time high of 20 gigawatts in early January. That has been a major contributor in removing risk premiums. Demand reduction continues to remain a key driver in the lower price environment. Price resistance has been linked to strong declines in gas demand across Europe. UK gas demand is currently 1% below the 6-month rolling average, with the strongest declines in LDZ demand that have kept below the 5-year average as mild temperatures remained for most of winter period. The second largest declines were linked to weaknesses in gas for power demand due to healthy renewable output, followed by minimal fluctuations in UK industrial demand. Gas consumption in Europe also continues to remain subdued, with consumption levels dropping below previous years in December, particularly in Germany's non-LDZ demand. Europe is expected to compete with Asia as a premium market for LNG until the second half of 2025, when significant volume of supply is expected to enter the market. In the meantime, European LNG imports have gradually grown month on month this winter, from 13 BCM in October to over 16 BCM in December. This is also a trend in the UK, as imports increased by 59% from October to December due to an open arbitrage to Europe, creating favourable LNG netbacks for US shipments. The Northeast Asian spot LNG price fell to an 8-month low, assessed at $950 per MMBTU, with high storage levels and increased nuclear output, which reduced near-term competition against China. Although long-term contract volumes remain robust at 100 BCM till 2029. Out of the 92 days of Q4 23, the UK has experienced above seasonal normal temperatures on 58% of the days. This, in tandem with strong renewables, has helped to suppress demand that led to the lowest monthly day-ahead electricity price of the year in December, averaging £69.48 a megawatt. Looking ahead, the latest weather forecast points to above seasonal normal temperatures for most of February, before consolidating below seasonal normal into March. This could add some price stability to prompt prices. Based on the latest balances for February, UK LDZ demand is expected at 182 MCM per day versus 170 MCM per day last year, whilst the European weather outlook also points to the same trend. Strong Norwegian gas flows and LNG arrivals have kept supply and storages well supported this winter. The US has emerged as the top exporter of LNG in 2023, exporting over 120 BCM thanks to the return of Freeport LNG and the start-up of Calcasieu Pass LNG. 63% of these exports arrived into European terminals, despite Asian hub prices sitting at a premium to Europe for most of the winter. Shipping costs meant that Europe was still the favoured destination for US LNG, and this is likely to remain the case due to the current Red Sea shipping route issues. If we see longer-term disruption, LNG companies could begin working together to rearrange flows and increase efficiency. For example, a Middle Eastern company delivering a cargo into Europe could swap with a US cargo destined for Asia. Both customers would receive their cargo, but with neither exporter using the Suez Canal. This activity is already the norm internally for global LNG players, but cargo swaps between majors could be a possibility. US LNG exports are set to grow to 38% of global supply by 2030 from 22% last year. 2025 will see a burst of new global liquefaction capacity beginning to come online. Currently post-FID projects total over 131 BCM. 61 BCM of this will come from North America. Qatar's North Field expansion project will see its first gas in 2025 before completion in 27, adding some 44 BCM of additional capacity. Over 80 BCM of new LNG projects are expected to hit FID in 2024 as appetite remains globally. However, compound annual growth rates for projects falls rapidly from 2028, so the window of opportunity could be closing for investment. After a heavy summer of maintenance, Norwegian exit flows have ramped up from November to reach their highest level since October 20. Flows in November, December and January have exceeded levels seen during the equivalent months since winter 20. A steady stream of maintenance is planned on Norwegian infrastructure between February 24 and July 24, with heavier maintenance expected from late August to early October 24. When compared with the 2023 season, total 24 capacity impact is reduced by 200 MCM per day. Heavier maintenance in late summer could present additional risk if we see warmer than average temperatures emerge following the strong El Niño event seen in autumn-winter 23-24. In recent years, heat waves have caused issues with nuclear output and river levels on the continent, thus increasing gas demand for power generation during storage injection season. Northwest Europe storage levels are on course to end the winter around 54% full, based on central weather scenarios, and this increases the likelihood of European storages hitting the mandated 90% ahead of the 1st of November target date. After reaching a record low capacity in 2022, French nuclear capacity improved significantly in 2023. Over 60% of capacity has remained consistently online since early November, with as much as 87% of capacity online in mid-January 24. We expect online capacity to gradually decrease in the coming weeks as we enter maintenance season, but current forecasts put online capacity as consistently above 70% for 2024. France reinforced its commitment to nuclear power at the COP28 summit recently and plans at least 6 new reactors. Japan's nuclear comeback saw generation increase by 50% in 2023, a post-Fukushima high, but forecast growth of 17% in 2024 could be at risk due to several potential delays to reactor starts. Delays would lead to increased LNG demand as gas-fired generation would bridge gaps left by delayed nuclear returns. The December 24 EUA is over 20% down on the highs seen in Q1 23. The equivalent UKA contract fell a staggering 61% from highs in Feb 23 to trade at record lows in December 23. A brief rally saw prices recover during 2023's last trading days, however both contracts have since shed 15% from 2024's open. Demand for permits has fallen due to increased renewable output, lower gas prices and continued lower industrial demand post-2022 crisis. Falling gas prices have incentivised gas over coal burn for power generation, which requires less permits. Looking ahead, further downside could be provided by largely negative spark and dark spreads to 2027. Negative margins means less thermal power plants are incentivised to forward hedge volume and thus demand for permits falls. In addition, whilst economic growth is forecast in 2024, demand destruction is likely to persist. Looking more specifically at EUAs, 86 million tonnes of additional supply will be auctioned to raise funds for the Repower EU plan. With demand from power generators falling, it will be hard for the market to absorb these additional volumes. Market movements stemming from position covering will also change in 2024 as the compliance deadline moves from April to September. Auction volumes have previously halved in August due to holiday season, but this will no longer be the case in an attempt to curb volatility during the new peak demand period. On February the 6th, the EU Commission is expected to recommend a target of 90% emissions reduction by 2040. This could challenge the recent bearish sentiment. In addition, the maritime sector is now included in the EU ETS, with the percentage of emissions requiring permits rising from 40% to 100% by 2026. We expect the UK ETS to include the domestic maritime sector by 2026. In the coming years, both ETSs will introduce a carbon border adjustment mechanism, and we could start to see demand increase from international companies as they begin to manage exposure to this. The UK government is also considering implementing a supply adjustment mechanism, much like the EU MSR, to deal with surplus allowances, as the UK ETS does not currently have a balancing mechanism to manage demand shift risks. Brent has depreciated by 19% since October 23, with the March 24 contract now trading below the $80 a barrel mark. The market dropped to 6-month lows in mid-December as concerns around weak commitment to output cuts from OPEC Plus and higher output elsewhere, including record levels in the US, were weighing heavily. Since then, price support has emerged as the escalating conflict in the Red Sea drove risk sentiment higher, as 12% of global oil trade could potentially have been disrupted. The conflict has led to freight rates for tankers having risen by 30% since mid-December, although weak economic growth, global surplus and diverting ships has kept some price resistance. Further price support was also driven by the latest growth demand forecasts from the IEA, EIA and OPEC for 2024, which are in a wide range between 1.24 and 2.2 million barrels per day, citing economic growth, tighter crude market in Q4 24. Although all these organisations expect demand growth to slow in 2025. The fundamental supply and demand picture remains bearish, but volatility will remain a theme in 2024. Markets continue to be sensitive, and managing exposure to wholesale market volatility remains key. In the coming months, any major upside would likely stem from an unforeseen event, such as a major LNG outage or geopolitical event, and so it's important to manage risk progressively by taking advantage of downside whilst providing the appropriate level of protection should the worst happen. A flexible strategy solution remains the best tool to achieve this. For larger energy users, this can be achieved with a flexible energy contract and a bespoke risk management strategy. Trident's framework solutions offer a flexible purchasing option with multiple risk strategy options to consumers who cannot access standalone flexible contracts. For customers who are more risk averse and prefer the certainty offered by fixed price contracts, we would recommend tendering your contract to the full marketplace as soon as possible. The April renewal round is almost in full swing and prices are at their lowest for over 2 years, so demand for pricing will increase in the coming weeks, impacting supplier turnaround times. That brings us to a close on this update. If you have any questions, please feel free to contact us. You can also find the latest energy market commentary from our experts on the Trident Utilities website and social media platforms. Thank you for listening.